I record it.
Yes, I'm sending this to everybody
Yeah, send that to me.
after recording. So if you miss anything, you can always go back and
Good.
get it then. All right. So let's share this screen real quick. Let's get to it.
What am I? I thought it was my wings.
All right. Can y'all see my screen?
Resin.
Yes.
Yeah.
Perfect. We're gonna be jumping around a little bit. So we're gonna be in the presentation, and we're gonna leave, and we're gonna come back.
Huh?
It's gonna be we
I'm
gonna
trying to take notes.
we're gonna make this fun. All right. So this is what class is about. Investing 101, everything you need to know to get started in the stock market and get started investing. Okay. Dang, okay. Here go everybody. Let me add these people real quick. I'm sorry, y'all. Let me add these people. People want to be admitted. Admit all. There we go. Bunch of people just at the same time. All right, here we go. What's up, everybody? How y'all doing? Thank you for joining me. Thank you for joining me. We was just getting started.
Hey, you think we're going past like 30 minutes?
Nah, we'll get through it. We'll get through it. Probably by like 9:15.
Yeah, that's straight.
All right.
Did you time yourself?
You said, did I time myself? I got the time right here.
Oh, okay. Did
Y'all
you
know,
practice?
y'all know I can talk for a little bit. So
I hope you practice.
yeah. So this is everything that you need to know to get started in the stock market. Let's go ahead and get this thing moving. Here we go. So before we begin, all right, I just want to make this very, very clear. There's certain things that we need to have in place in order to before we even think about investing. Number one, we need to develop first an abundant money mindset. An abundant money mindset. We have to develop and create this mindset of abundance, of wealth, of more. Okay, we're on this earth for more. We're not here to just be stagnant and sit around. We're here for abundance. Okay, step two, we got to educate ourselves. Take time to understand for yourself. Yes, you're here now, which is the first step. But the next step after this is after you get the video, make sure you go back through it. Make sure you go and educate yourself, learn more. And from the examples that I show you tonight, you go back and look at your own examples. If you have companies that you want to look at, or stocks or ETFs that you want to get into, you go out and actually practice. All right. Again, I'm showing you stuff that's going to help you execute. So you'll be able to leave here and actually go through the stuff that I show you and do it on your own and begin to educate yourself on this stuff. The next thing is get your money right. All right. We have to practice good money management and risk management. What I mean by that is you can't just go from, barely getting by to just throwing whatever you got, in the pot into investing. That's not how I want to teach you. That's not how I want to set you up, because that's the quickest way to failure. Because if anything goes wrong in your life, okay, remember, this money that we're investing is for the future. Anything that goes wrong, any emergency, anything that pops up, you're gonna have to take the money out of your retirement account or out of your investment account. And y'all already know things get taxed, and they get taxed even more when you take them out before you're supposed to take them out. Step four, we have to eliminate debt, or at least have a debt elimination plan. We have to eliminate debt, or at least have a debt elimination plan. So what I mean is, if you got $3, $5, $10,000 of debt, that's something that we can work on getting rid of pretty fast, so that you can really start putting the money that you're putting towards debt into building wealth for yourself. And we're gonna talk a little bit about that later as well. Step five, we have to figure out the kind of investor that we want to be based on our risk tolerance. I'm a very aggressive dude, and I can be that way. I'm a little younger. I understand the stock market very well, so I'm able to take a little more risk than most people. But what you need to understand, and what you will understand after this, is how to base your own risk tolerance based on how you are as an investor, based on what you believe. All right, so everybody got that? We good?
Mm-hmm.
Just nod your head
Yes.
if you're good. Cool.
Yes.
Hey, how much money like would you want to start with? Like if you have no debt, no nothing, like what would you want to
Nope.
start with?
If you have no debt right now, your situation, you living with parents, right?
Yeah.
I would most of my money I would go towards investing. I would probably put like 10% to 20% in the savings.
Like if
That's
you have
just
$1,000, I should put that straight into there.
yeah. If you have $1,000, I would save 300 and I'll put 700 into the market.
Yeah.
All right, here we go. Next slide. So the very first thing that we need to understand when it comes to investing is interest and compound interest. Okay, we all know what interest is, especially if we have these banks and these credit cards and this debt and car loans and all that stuff. Okay, but what we need to understand is something called the time value of money. The time value of money. Okay, which basically means like $1 today is worth more tomorrow based on the interest. Okay, but that takes time. It takes time for that dollar to grow. And of course, we're gonna have an example. Of course, we'll have an example later on. Okay, so we all know how banks work. If you don't, I'm gonna explain it real quick. Banks are like the middleman. Okay, banks don't really have your money inside those banks. They take the money that you give them or that's direct deposited to them. They take it and they do it exactly what you want to do, which is invest it. They invest it through loans. They invest it by buying real estate or buying other banks. They invest it by investing into the same market that you want to invest in. So they take the same money that you got, they invest it, make 10 to 30% on your money and give you 0.01%, 0.05% on your money. So they're making 30% and only giving you 0.05% on your money.
Okay.
All right. We'll talk about that a little bit later too. So how investing works is compound interest. So interest works for you or work against you. In investing, compound interest works because your money based on your interest is going to stack on top of each other. It's basically the interest stacking on top of the interest. So let's look at this example real quick.
Oh,
Let's look at this example. So for example, we have the bank, okay? Starting in January 2021. Let's say you put $100 into the bank. The average bank is giving you about 0.05%. Next year, you will have $100.05 in your account because of the bank.
mm,
With investing into the stock market, let's say you earn 10%, you put $100 in there, January 2021. By January 2022, you will have $110. Okay, that's a like a 2,000% difference right there.
Hey,
By
you
simply
know
investing.
like the S&P 500, like don't they like grow every they grow like 10% like every month or some shit like that?
Yeah, every year on year, the S&P for the last 40 years have done like 12%.
So it's like always growing.
Yeah. And it did like 15% this year, even with COVID. So let's talk about risk and reward. Okay, this is another concept that we need to understand when it comes to investing: risk versus reward. So remember, if you have little risk, then the rewards are going to be very minimal. So putting your money into the bank is almost like a guaranteed thing because they go out and make a ton of money, and so they're able to basically guarantee you 0.05%. There's no risk to that. All right, your money is backed up, is FDIC insured, so you have money there whenever you need it. It's little risk, little return. You have medium risk or conservative. Okay, this is medium reward, investing in quality, what I call large cap companies. So the big companies, Walmarts, the Home Depots, the very established companies, the Apples of the world, the Amazons.
Well,
That's your medium risk, conservative. Then we have the high risk. Of course, with high risk, there's greater returns. With
Mute
high
your
risk,
mics if you're not talking.
For
thank
real.
you so much. With high risk, there's greater return or greater rewards. Okay, there's more money involved, and invest, and that involves investing into mid to small cap companies. So we have to understand our risk to reward. Where do we want to be? Do we want to be have medium risk or conservative risk, or do we want to have a high risk to reward? Are we able to withstand a high risk to reward ratio? Next thing we need to talk about is inflation. So we all know what inflation is. The cost of goods and services increasing over time. So usually it's about 2 to 3% per year. Back to the bank example. If you have money inside of a bank earning 0.05% and inflation is 2 to 3% per year, you're guaranteed to lose money. Let me say that again. If you're earning 0.05% at the bank, but inflation is 2 to 3% per year, you're guaranteed to lose money by having all your extra income, the money that you don't really need after emergencies, sitting in the bank. I'm not saying don't use a bank, because banks are important for emergencies, for anytime you need emergency money, but don't put anything outside of 6 months emergency into the bank, or more, depending on your risk tolerance, of course. So next, when it comes to pick your investment plan, okay? What are your goals when it comes to investing? What are you looking to accomplish? Are you looking to create generational wealth? Are you looking to generate extra income by trading stocks? Or are you looking to do a combination of both? Okay?
Combination of both.
Right. That's a lot of people.
Yeah,
But
definitely.
the first step is the long-term invest. Why is that the first step? Well, that's the first for beginners, because when you're just getting started, most of the time you don't have the time to, do all the research and, look at the charts and everything that most traders or people who make the income by trading stocks do. It's almost like a full-time job to be able to evaluate and research all the companies that you want to research. So it's important as a beginner, when you're first getting into the game, to understand and participate in long-term investing. Let that be the foundation for the short-term investing, for trading, for making income in the stock market. That has to be set up first. Okay, I'm big on the foundation piece. I have a background in sports. I used to do the same drills over and over again because that was the foundation. Whenever I got tired and I couldn't perform at a high level, my technique, the foundation that I had and that I built from doing the same reps over and over again, is what helped me be elite, helped me be an elite player even while I was tired. And the same thing can go into investing. You have to create a foundational plan that even in the short term, if you're trading, if you're investing into stocks, individual stocks, you have a backup plan. You have the long-term foundation that you can stand on so that you're able to mitigate your risks. You can continue to go forward with having a small loss in the short term, because in the long term, your money is growing and taking advantage of compound interest. Y'all got me? Y'all sticking with me? Y'all still with me?
So like when your investments like compound, like how does that build, how do you build interest on that? Like how does it compound?
So when you earn interest, let me go back.
I mean, I just don't understand like the concept of interest, I guess.
Yeah, I got you. It's a hard concept to understand. It's like Einstein called it like the eighth wonder of the world, because it is really hard to understand. A book that I recommend that y'all read is the Compound Effect. It kind of explains it a little bit more. But basically, if you take a penny and you double it for 30 days, it turns into like $5 million or $3 million or something like that in 30 days. You take a penny and you double it for 30 days, it turns into like $3 million. That's compound. That's the power of compound interest.
What's
So
the book called?
The Compound Effect. It's by Darren Hardy. All right, so it's basically saying the little steps compounded or added on top of each other day by day adds up to a whole lot.
Who's the author?
That's exactly how the stock market works. That's exactly how interest works. If you ever wonder why most people feel like they'll be in debt forever or why they can never get out of debt, it's because compound interest is working against them.
Mm-hmm.
Compound interest is working against them. The debt is having compound interest work, because most cases debt gets compounded daily or monthly. So it gets multiplied even more. So that's why I say we got to have a plan to eliminate the debt, because if you have a bunch of debt and your debt averages about 20% per year, and you're trying to invest at 12 to 15% per year, well, you're losing 8 to 5% per year. You're losing 8 to 5% on your money. All right, so it comes down to this: there's active investors and passive investing. So how much time are you willing to commit, or how much time do you have to commit? Active investors tend to, do a lot of research, tend to be behind the computer and look at charts all the time. Okay. Passive investors do, what I teach, the long-term approach, putting $100, $200, $300, $400, $500 into a Roth IRA over time, letting that grow passively. And then of course there's both. You can do both, like I do. Okay.
Which one did you start doing first?
Long
you did
term.
the long-term one? Yeah.
Passive.
Yeah, we on the same page. I got you.
Yeah, that's where everybody gotta start. I don't care what you say. I don't care what people tell you. I don't care how many, gurus or ads you see on YouTube. You gotta start long term.
Yes,
and if they don't tell you to do that, then they're just trying to make some quick money. So now we get into the nitty gritty. So what do we invest in? Okay, there are many different vehicles to put your money into when it comes to the stock market to make big gains. So what do you choose to invest in really depends on your investing style or your risk tolerance. That goes back to the risk and reward. How much risk are you willing to take for the reward that you're willing to get? So these three things in the stock market are what's key for long-term investors and also short-term investors. We have stocks, ETFs, and mutual funds, and I'm about to break these down right real quick. So if you're taking notes, I'm just going to stocks next, okay? So let's break down the stock. A stock is a share of ownership or equity within a company. Whenever you own a share of a stock, you become what's called a shareholder. Since you're a shareholder, okay, you get represented by a board of directors by that company. And that board of directors makes the decisions based on the well-being of the shareholders. So the board of directors wants the company to make money. They want the company to keep valuation to increase. They want you, if it's a dividend paying stock or a dividend paying company, they want you to continue getting dividends. And we'll talk about that a little bit later. Okay. These companies, since you're a shareholder, you have access to company calls, to voting, to annual reports. All right. Like I just got sent an email today about the Apple annual conference, about joining that conference.
I received that as well.
Yeah. If you're a stockholder, you get those type of things. So they have to report, they have to keep you in a loop because you're investing into their company and you need to know what's going on. Now, do you need to attend these things all the time? No, you don't really need to, but it's a good thing to attend at least once or twice so that you understand what's going on and what they're talking about. Because sometimes they tell you things that they don't tell the public first. They let you know first, and then they go into the public. So you can know things about what's happening with the company and what's coming out next. So here's some stock lingo. Here's some stock lingo. So whenever you're looking at a stock, here's some things that you'll see. So you'll see the 52-week high. That's just the high price, the highest price that is hit in the last 52 weeks. So it's always a revolving 52 weeks. So the last 52 weeks always falls off. It's like a revolving door. Every 52 weeks, you get a new high. You'll get a high or a low. 52-week low is just the opposite of that. What's the lowest price that it's been at in 52 weeks? Okay. If you see a big difference between the 52-week high and the 52-week low, that means that company is very volatile. That means that is a very volatile stock. That means it's very high risk.
Okay.
If you see it shooting up to $70 and it was just $10 2 weeks ago, that's very volatile. The sustainability of that is not common. It'll probably go back down. The next lingo we have is ticker symbol. So y'all, when y'all was on my lives, y'all hear me say the ticker symbols all the time, VOO, CHWY. It's usually a 3-letter or 4-letter ticker symbol. Usually a 3-letter or 4-letter ticker symbol, okay? If it's longer than that, like if it's a 5-letter ticker symbol, then it's probably a mutual fund. It's probably a mutual fund. Mutual funds usually sound like FSAAX. They usually have an X in the ticker symbol for some reason with mutual funds. Okay.
What's a mutual fund?
We're about to go through that in a little bit.
True.
So dividend yield. Okay, this is the percentage that they pay out on a yearly basis. So a company is based on the price of the stock though. So if you own a share of a stock that's like $100 and they pay out a dividend yield of, let's just say 5%, just to keep the numbers simple. They pay you $5 a year for one share, per share. That makes sense?
Yeah.
I have a question.
Yep.
Back to ticker symbol. What does the W stand for when they mean by if you have AT&T and you have like AT&T ticker symbol T and have like W, that stands for like warrants. What is that?
Yeah, a warrant is a whole different. That's a whole different type of investment. So it's like you're betting. It's kind of like you're holding money for the company, just in case like the price goes down. And it's a big bet. Like it's something you don't really even want to dabble with unless you know you're very knowledgeable about it. So it's the warrants are it's like a bet. You're placing a bet that the price is going to keep going up or going down based on whatever warrant that you buy.
It's like elite.
That's a little high level.
That's elite.
A little high level. Okay. Next we got is PE ratio. PE ratio. All right. This is the price to earnings ratio. So a high price to earnings ratio, and it differs based on the sector. There's many sectors. We got consumers stocks, we have industrial, we got electric vehicles, we got clean energy, it's a whole bunch of sectors. We got utilities, we got all that. But the PE ratio basically just tells you if a company is overvalued or undervalued. So if you see a high PE ratio, like something over 30, 40, then that means it's overvalued. If you see a low PE ratio, anything below 15 is undervalued. So I know a lot of value investors, they look for PE ratios under 15 because that means the company hasn't really hit its peak yet, and that eventually it'll catch on.
What does PE stand for?
Price to earnings. So the P stands for price and the E stands for earnings.
So if it's over the 40, is that good or bad to invest in to get that stock?
So that means if it's over 40, and it also depends on the sector, but if it's over 40, then it's overvalued, meaning that it costs too, like it's high price. Like how can I put an example? Like you wouldn't buy a TV for $3,000, would you?
No.
It's overpriced. You wouldn't buy that. So investors aren't willing to put money into it because the price is too high right now. They're going to wait till prices go down to start buying into it. So no, it's not a good time to buy.
Thank you.
That help?
Yes.
All right. All right. So then we got the high and then we have the low. So the high is the high for that day. So the high price for that day and the low price for that day. That goes back to, the volatility. If you see something, if the difference between those prices are big and it's very high volatility, you don't want to be in a stock like that. It's probably a penny stock. Okay. Close is the price that it closes at the day before. Open is the price that it opens at the day before. The net change, this is the return. So whatever return that the particular stock or ETF made in that day. And we about to go through an example. I'm gonna show you that in a little bit. And then volume, this is very important too, because this shows you how many other investors out there are putting money into this. Usually when something has a lot of volume, that means it also has a lot of liquidity. So it's a company that's generating a bunch of money from its shareholders. And you're able to buy in and sell out of that company at a quick rate because there's a lot of buyers and sellers if it has a lot of volume.
Do you know the volume of Bitcoin?
Nah, I don't, not offhand.
It'd probably be like crazy high, right?
Yeah, it's probably crazy high. Like a lot of people are in and out of it all the time.
Yeah.
And it's also a speculative, like it's a very risky investment. So let's look at Facebook.
Hold up. So high volume, right?
Yep.
That's good.
Yeah, high volume is good. High volume is a good thing.
So you can't have like a good low volume?
Low volume just means it's not it's so the volume
Like
it
can't like succeed.
Go ahead. What'd you say?
It can't succeed if it's low volume or what?
Nah, it can. The volume just lets you know, like if you're going to buy the stock, how quickly you'll be able to get in, how quickly you'll be able to buy.
Oh, I didn't hear nothing you just said. You blanked out.
Can you hear me now?
Yeah, you good now.
So the higher the volume, the easier it is for you to buy the company at whatever price that you want to buy it at. The lower the volume, the harder it is for you to sell or buy and get into that stock.
So is the low volume risky or no?
No, it doesn't have anything to do with risk.
No.
Volume just has to do with being able to buy or sell it.
You know, like an example of like a successful low volume stock or whatever?
Not off the top of my head.
Yeah, it's straight.
You good now? Y'all good?
Yeah, we cool.
I had a question that I did in the chat, if you don't mind, please.
Yeah. What's up?
I'm not good at operating this thing, but in my question, I was trying to ask about the high volume. Where do you find that when you're looking at a stock and all the information about it?
I'm going to show you that right now.
Yeah, we get into that. Yes, sir.
I'm going to show you that right now. And I'm sorry if I'm not answering y'all questions. I didn't even see that y'all were putting stuff in the chat. All right, cool. So yeah, I'm going to go through all this right here. So we're looking at Facebook. This is a picture of Facebook and everything that I just talked about. So we have, I didn't have market cap on there, but market cap is basically just how much the company is valued in the market. Facebook is a big company, so 605.1 billion is a pretty big market cap. Okay, this is a large cap company.
So the higher the market cap, the better?
The higher the market cap, the more solidified the company is. So So large cap companies are more stable. That's basically what that means. They're more stable, so they're less likely to go out of business. Their price,
So at the end,
price is more likely to stay consistent and not dip and go up so much and not be so volatile.
so if you invest, it's basically like a win-win at the end.
Yeah. Large cap companies are good to invest in if you're like a value investor. If you just want, just large cap growth, steady growth, large cap companies are good to invest in. And that's what the S&P has a lot of large cap companies in it. That's why I recommend, the S&P 500 ETFs, because they have a lot of those large cap companies in there, and it's a good value for your money over time.
How many markets are there besides the S&P?
There's NASDAQ, there's the New York Stock Exchange, there's the Dow Jones Industrial, there's the London Stock Exchange, there's the Japan, it's a whole bunch.
Yeah, there's like more than 10.
Yeah, So yeah, let's look at this real quick. Let's go through this. So the high today, remember I was talking about high, so that the price was at 213. The highest was 213 today. You see the price when I took the picture was 212. The 52-week high was 224. Okay, so the highest that it hit for the last year was 224. Price to earnings, so 29.1. So Facebook at this time was kind of like overvalued in people's eyes. They still thought it was overvalued, but it was still a great company. Right now they're going through a bunch of like lawsuits and stuff like that. But it's at the end of the day, it's still a great company. The low was 210, so only a $3 difference right here, not very volatile at all. 52-week low was $137. 52-week low was $137. Okay. 52-week high was 224. And that's not bad for Facebook, because it's at this time when I took this picture, it was probably like 2 years ago, but it was still growing. It was still a growing company. The open price, it opened at 212.14. The dividend yield at this time, Facebook didn't offer dividends at all. The average volume, so the average volume is how much volume it has on average per day. 26.31 million is really good. It's really good. 12 million is really good. Really, anything over a million is good for, getting in and out of a company, like I said.
How did you get this information? Like this whole box?
Oh, this is from Robinhood. I just took it from Robinhood real quick.
So Robinhood lists this stuff?
Yeah, Robinhood has it right on the app. Like
for everything?
Yeah.
Gotcha.
And can y'all see this here in the top left? This is this is the change, the return, the net change that I was talking about on the previous page. So for today, it's up 0.52%, so up $1.09.
Okay.
And after hours, so after hours is just the time between 4 to 6 when the markets are after hours. It did negative 0.02, so it lost 5 cents in after hours.
Wait, so what's the timing? It's what time is it open?
So it's open from 9:30 to 4, and then after hours is from 4 to 6.
And then what about weekends?
Weekends is closed. The markets are closed.
Oh, yeah.
And holidays and all that good stuff.
So 4 to 6 is closed?
4 to 6 is after hours. So it's still, yeah, it depends on your broker. Like if you have a broker that lets you trade after hours, then you can still trade after hours. But most people don't do that anyway. It's just.
Is that M1 Finance? Does that do that?
Nah, M1 Finance is only during day trade during the daytime. Not
Oh, so you have to have your brokerage to let you trade on the right time and shit and stuff?
Yeah. All right, so let's talk about ETFs, okay? ETF, what time is it?
Yeah, sir. We've been going on. Yes,
It's
sir.
all right. It's all right. So ETF is a basket of stocks that typically mimic an index or a sector. So it usually has lower expenses and fees, kind of like VOO. I talk about VOO a lot. Now, a mutual fund is a pool of investors. So it's like all of us here on this Zoom call, we come together, we invest into a fund, we put the money into the fund, and there's a fund manager that manages that money for us and gets a high return. That's why mutual funds have higher fees, because there's an actual person that's managing.
Right. Okay.
I have a question.
Yes.
What is the definition for the acronym ETF?
I didn't put that on here, did I?
Nope.
So ETF is an exchange traded fund. I thought I put that on here. It's an exchange traded fund. So like it mimics an exchange, an index, or a sector.
Can you go into a mutual fund a little more? My bad.
An index is like the S&P 500 or the NASDAQ or the New York Stock Exchange. And the mutual fund, like I said, it's a pool of people. You can have an unlimited amount of people, a pool of people that invest their money into the fund, and there's a fund manager that manages the money for you. So there's actually a live person that manages it for you, and because of that, there's higher expenses associated with the mutual fund.
And what about yourself? Are you able to be a fund manager for a mutual fund if we were to want to go into a group? I'm just asking, you know.
I could. It's a lot that goes into that. I'll have to get licensed and stuff again. I was licensed at one point, but I let it lapse because I didn't want to I just want to do my own thing. I didn't want to be tied to a company. I kind of just wanted to put my name and put my stamp on anything that I do.
That's not your main job.
Now, let me ask you this. So are the returns higher on a mutual fund, if that's the case?
Yes.
So I'm gonna break all that down for you in a little bit. I got all that in these slides. If you can be patient with me, I got you. All right, so let's go to the next slide. Let's get it moving here a little bit. So
this class needs more than 30 minutes.
Yeah, let's talk about doing your research. Okay, so here's the thing: if you don't understand what you're investing in, it's a bad investment. If you don't understand what you're investing in, it's a bad investment. Don't invest blindly. You would never get involved with anything if you didn't know what it was about. Always do your research, please. I say that nicely, but always do your research. Okay. So these are the 3 questions you should ask yourself. Does the company make money? You want to look at the revenue and you want to look at the net income. And I'm gonna give an example here in a little bit. How do they make money? What is the business model? And lastly, do they have a competitive advantage? Like, is it hard for another company to copy them? Do they have a business model that's hard to copy? On ETFs, okay, this is how we do the research on ETFs. Again, like I said, you don't want to blindly invest in anything, even if it's considered a safe investment, okay? ETFs usually have a large amount of companies in them. And if you don't agree with those companies or how they do business, don't invest in it. You must know these things, you must do your research. And particularly with ETFs, it doesn't take long. And I'm gonna show you an example of that too. So when was it created? That's the first question you should ask yourself about ETFs. When was it created? And I'm gonna tell you why in a little bit. How's the performance? How did it perform since it was created? So since inception. Inception just means when it was born. And number 3, what are the holdings? What are the top holdings that it has in the ETF? So let's do a live example. I'm gonna hop off real quick. Let's look at Chewy. Okay, y'all know I like Chewy. Let's look at Chewy. I'm gonna zoom in for y'all real quick.
It's Chewy.
And look at that. Most companies are registered in Delaware just because of the tax part of it, but it tells you all that they're registered in Delaware and all that. But this is called a Form 10K. It's basically their annual report every year that they put out, and it's gonna give you all the information that you need, like all of it. You don't have to go through it all. It's like a 52-page document. I'm gonna show you exactly what you need to look at. Okay, so again, first thing is, does this company make money? Matter of fact, let me just go through the pages real quick. So they give you a table of contents, thank God. All right. First thing we want to look at is item 1, the business. When you look at the business, it's going to tell you how they make money. It's going to tell you what they do to make money. Then you want to look at the financials. Which is usually item 8 on the 10K. So financial statements and supplementary data. And that's pretty much what you need to look at. Okay, but it's a lot to digest. Let's go to part 1, which is the business model and everything. Okay, so Chewy's is going to tell you. Here we go. This is where I get my information from. So if y'all think I'm just smart, I'm not. I promise you. Okay. So remember, I was telling y'all about the projected growth of pet spending. Okay, 2018 spending overall pet market has grown from 73 billion in 2014 to 95 billion in 2019. Okay, this is a 2019 report. They didn't put out the 2020 report yet. Okay, or a 5.4% compounded annual growth rate, which is really good. Okay, the rapid shift to online shopping. Remember, I was talking about that. Okay,
Yeah.
this represents over a 40% compounded annual rate for online pet retail. They're talking about the pet industry and internet shopping. And then here's the kicker, the growing trend of subscription-based purchasing. So research indicates that 72% of pet owners made at least one online purchase for their pet in the past 12 months. And 39% of those were subscription-based. Like, that's a huge percentage. About 40% of people are subscribed to their pets and getting their pet stuff. Okay, it's going to tell you their strengths. I'm not going to go through all that right now. The company's strength, all right. But basically, they're able to get people their stuff fast. They're scalable. It's all online. Okay, it's going to tell you their strategy, which is their business model. They want to continue to grow their sales. They want to get new customers. They want to leverage technology. Okay, expand further into pet healthcare. See, this is pet healthcare. So not only do they do toys and stuff like that, they're trying to get into pet healthcare. So this is this is where you find all the information. They will literally tell you. This is where you find a competitive advantage. So competition. So the pet products and service industry is highly competitive. Okay, competition in the pet and service industry is strong. Okay, we face competition from the websites, but we believe that the principal competitive factors influencing our business are price, product selection, and availability, fast and reliable delivery, and customer service. So that's their competitive advantage, which they do very well. Okay, remember, I work at FedEx. They get stuff. I deliver these packages to people. They was like, "Yo, I literally like bought that last night at like 9 p.m. and it's here already." So they have a very good system going on, and it's very competitive.
What stops them from inflating the reports? I'm just
stops
curious.
them?
I mean, do they ever have issues with the inflating?
They can't. If they do, they can't be a company. They can't be publicly traded. So as a publicly traded company, they have to put out these reports. Like, it's a mandatory thing as part of being a publicly traded company.
I have a question.
Yeah.
Where can we find this form for every company?
So you can literally just type in the company and type in Form 10K and it'll pop up. So like
Okay,
that's,
thank you.
yeah, that's what I did. Let me go back. I put Chewy annual report 2019, and this is the first one right here. It's
Can you
always
go
going
back
to
to
be on there. It's always going to be on their investor site. I'm sorry I didn't show y'all that earlier.
can you go back to growing trend of subscription-based purchasing and then like the two ones you did before that?
Real quick. I got you.
Yeah, just like the two, like you did the growing trend of subscription-based purchasing and then like the ones before that. It was like the ones that you like singled out.
And I have another question. I'm sorry.
Mhm.
For the Form 10K, that would be for the ETF only, or also for the stocks or the mutual funds?
So right now we're just talking about stocks, individual stocks. I'm gonna show you how to do the ETFs in a little bit. So this is the growing trend subscription-based purchasing. And now mind you, these are going to be different for each company because each company has different business models. So some companies don't have subscription-based purchasing. A lot of companies are moving to that now, as y'all can see with Disney Plus and Amazon and Apple and all that. But a lot of companies aren't in that place yet. So whatever company you're looking at, they may not have a subscription-based part or whatever. So it just all depends on the business model.
And then like the ones that you singled out before that, like the highlighted,
Yeah, it's just,
or like the in bold.
yeah. So
Like
all
the
is
important ones. The important ones.
it's right under the business part. It's like the overview. It's
Overview.
gonna tell you about their industry, what industry they're in, and based on the company, it's gonna give you all the highlights of the historical data and all that type of stuff. All right, so I mean, I'm gonna send you the video so you'll be able to go back and see it.
Yeah, we good. I don't know. I'm taking too many notes. We good.
I got you. So let's go down to the financials really quick. Really quick. Here we go. All right. So this is a consolidated financial statement. This is not what I want to show y'all. Okay, you can go through it. Where is it? Accrued expenses, boom, 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 self-insurance. I think I went down too far. Hold on. Yeah, it's a bunch of pages, y'all. A bunch of pages. So we're trying to look for item 8. All right, here we go. So net sales, okay? Net sales is exactly what it says, the net. So after everything. This is not revenue, this is the net income. So in 2019, they were positive at 4.8 million in net sales. In 2019, okay? You want to look at revenue and net income. Their net income was 4.8 million.
Okay.
That's after taxes, that's after depreciation, after deductions, all of that. Okay. I want to show you all this right here too. Okay. So this is cash flows from operating activities. They had a net loss in 2019, but it's decreasing. They always show the last 3 years. It's decreasing, which is good. That means they're making more money and able to pay off things. All right. So it went from 338, almost 100. Yeah, it is over 100,000 more in 2017 to 252 in 2019. So that's a good sign. Whenever you see that, that's a good sign. All right. Now here's another thing. So this is net. This is cash and cash equivalents. So this is basically cash on hand. So this is how much money they have saved in their saving account. And this, you want to see this number increase. want to see this number increase. So obviously there's more than double in 3 years, which is really good. That means they're making more money. They're able to put cash into their savings account.
Is there a chance that they fudge those numbers, or do they have to actually have proof of those documents?
There's no chance. Like there's so many regulation rules to be in a public company that I'm sure y'all see the like the news reports where they talk about companies that the Chinese companies, more importantly, about how the Chinese companies you know, fudge their numbers to make it look good.
Right, that's what I was saying.
Yeah, so that's the Chinese companies have different rules than the American companies. That's why I don't normally get into Chinese companies, and that's why they had this whole, you know, debacle about getting rid of Chinese companies off the exchange, period, because they were able to mess with their numbers and make them look better than what they actually are. But with American companies, it's super regulated. Like they cannot do that, or they're going to get kicked off the stock exchange. And then when that happens, they might as well call it quits. Like the business is over.
Okay.
All right. So that's it for Chewy. Okay. We know the business model. They have a subscription model. We know the competitive advantage, and we know the money. We see the financials. Now let's look at an ETF. So this site that I'm using is Morningstar, but you know, you can use any site that you want to. I just like Morningstar because, I mean, it gives me everything that I want. So what you want, the questions that you want answered with your ETF is when was it born? So when was it started? How did it perform? And what stocks does it have? What are the holdings? So you can go to Morningstar. It's a really simple website to use. Just type in the ticker symbol here at the top. You go to search, type in the ticker symbol. This is the ticker symbol, VOO, and it'll pop right up. Just click on it and it'll pop right up, okay? I go straight to the performance tab. Ad popping up. Straight to the performance tab. Come on, ad, get out the way. So this website got a whole bunch of stuff going on. Like it's live updates, it's all that. So it takes a little bit. Whenever you get on this website, I would probably recommend you get on your phone or something, because, and you see me, I got a whole bunch of tabs open, so that's probably making it slow anyway. Like, but just go to the performance tab and come on now. Here we go. I'm gonna let it do its thing. Let me close out of Chewy. All right. Dang, people was trying to get into class, they missed it. People are hitting me up. Like, is it too late for class? Yes, I'm sorry.
Yeah.
All right, so come on, pop up, pop up, pop up. I should have just took a screenshot and put it on the thing, but it's whatever. I wanted to show y'all live. Let me see if I can share my phone screen real quick.
So I have a question while you do that.
Yeah.
So,
Who's speaking right now? I'm sorry.
Krista.
Hey, Krista.
Hi. So I currently have stock with one of my old employers, which is a grocery store, Publix. And they, of course, are not publicly traded. So like, I don't know how would I go about, like, I don't know if you know the answer to the question, like seeing the results of what I have so far. I know before I left the company, it was at like 10,000 and I was there for 3 years. So I'm pretty sure it's grown more.
So what do you have with the company? A 401k or?
No, I purchased stock. They have an employee stock purchase program, and they give us shares as well as we can purchase shares.
Oh, okay.
Yeah.
I didn't know that. So what you gotta call them. If you're not working there anymore, I doubt that they still have it growing. Because what they usually do, if you're not working, they put it into like a cash account. So it's basically just cash sitting there right now. But I would call them to make sure. And ask them if there's a way that you can roll it over if that's what you want to do. And put it into another account for yourself so that you can manage it.
Okay.
All right. If you need help, just DM me or message me, and I got you.
Okay. Thank you.
Yeah. All right. So y'all can see this.
Mm-hmm.
All right. So we're on the performance tab right now. The first thing that it's going to show you is if you put 10,000 into this fund 10 years ago, what it would have turned into. It would have turned about 37,000. Okay. It was barely under the index, so the S&P, barely under that. But as you can see, it tracks. It basically mimics the S&P. Okay, VOO is the blue line. The S&P is the red line. It basically tracks that entire thing. So, what we're looking for, like I said, is the inception date. So when it was created. So you're gonna scroll down here to where it says trailing returns. Remember, we're doing ETFs. Go down here to where it says trailing returns, and right up under here, it's gonna give you little cliff notes about the returns and everything. And it's gonna tell you right there, inception date, September 7th, 2010. So mind you, during this time, we were still kind of going through the recession of 2008. And it was able to still be profitable, still be able to be a good fund even during that time. And even with this, these are returns since January 13th. So this has the 2020 crash in it as well with the pandemic. So even with all of that, even with the recession, even with the pandemic in 2020, those are two major crashes that happened in the market. Let's look at the performance since inception.
Mm-hmm.
Since inception, this thing is still done 14.97% year over year. This is since 2010. All right. So those are the first things that we want to look at. We want to look at the inception date, which is in 2010. That's going to let us know what it's been through. I like investing in things that's been through some storms, and that showed me that they can weather the storm. And this one weathered the storm really well. Both of them. 2008, coming out of that, and 2020. It's still done 14.97. Matter of fact, it was up 17.72 in 2020.
Okay.
Even with the crash. So this is stuff that you want to look for. This is the type of research that you want to do. The next thing, we got to look at what's in it. So we go to portfolio so that we can see what's in it. Now this is the S&P 500. It's the 500 companies that's on the S&P. S&P stands for Standards and Poor's. It's a bunch of rich dude names.
Mm-hmm.
Hopefully this don't take forever to load up, but it's basically companies that's on the S&P 500. It's gonna have your Googles, your Amazons, your Netflix, your Microsofts, your Johnson and Johnsons, your Pfizers. All that. So let's go down. Up. We go to ads again. We go to ads again. How I know next time I'm gonna just take a screenshot. Just take a screenshot. But yeah, y'all know. Go to the portfolio. You'll be able to see all the companies that's in it. You'll be able to see all the companies that's in it. It should show you the top 10, and then it should let you see all the other ones. It's over 500. It's gonna give you a breakdown of everything. It's gonna tell you what it's mostly comprised of. Oh man. Sorry, y'all. Y'all bear with me.
Mm-hmm.
So I got a question.
Yes, sir.
All right, so the VVO is the thing that you talked about when we on your TikTok video, that last one you did. I think it may be your last one, where you told us to go and do a mutual fund through like Charles Schwab.
Yep.
Are we gonna talk about that tonight? Because I got some issues with that. Well, I had some issues I got my thing set up with Charles Schwab.
Yeah.
But I got some issues with how to pick it again. How you you know how I pick it and which one I pick.
Yeah. So Charles Schwab, they don't let you do fractional shares with ETFs. So the way around that is you would have to do their stock slice feature, where you're able to invest fractional with the stocks.
So who lets me do it fractionally then? Like you did it on
Fidelity,
TikTok.
Fidelity and M1 Finance. Fidelity and M1 Finance, they let you buy straight into the ETF fractionally. Charles Schwab is whack. You like they probably make you have to buy the whole share, and then you got to call them and tell them that you want to, invest monthly with it. That just takes too long because you're gonna be on the phone forever.
Okay.
All right.
So just go over to Fidelity and do it through them.
Yeah, open an account with Fidelity, you'll be able to do it with them. If you need help, just schedule a call with me and I can help you set it up.
Okay.
How much does it cost to establish an account with Fidelity or M1 Finance?
It's completely free. You just gotta fund the account. So with Fidelity, there's no minimums at all for a Roth IRA. With M1 Finance, you have to put in $500 to open the account. But if you're gonna invest, you're gonna have to save that money anyway. So if you like, I like M1 Finance the best. So, I would just save 500 and put it in the M1 Finance. But if you're ready to get started right now, then Fidelity is the best choice. So, all right, this is the portfolio tab. It's going to show you what sectors that it's invested in, and how much. Okay. So this one is mostly made up of technology. It has healthcare, financial services, and communication services. So like AT&T, T-Mobile, all them. That's the top 4, 5. Okay. None of this stuff really matters at all. It really doesn't say anything. All right. You can scroll down to the bottom and boom, it's going to show you the top 10 holdings. Apple, Microsoft, Amazon, Facebook, Google, Berkshire Hathaway, Johnson & Johnson, JP Morgan, and Visa. All good companies, all quality companies. Look at the return of these companies individually over the last year. 12, 21, 20, 12, 67, 32, 65. All right, these are good companies. Even if you invest in them individually, right? Like if you had Charles Schwab and you couldn't do the fractional shares with the ETF, you can buy the top 10 of these companies and you will be solid. So that's basically the 3 things that you need to look for: inception date, the performance since inception, so the rate of return since inception, and then the holdings that's inside the company, that's inside the ETF.
Vanguard. I think that's what
Okay. So I'm sorry that took so long. We about to wrap it up right now. And then we're gonna get to the person that gets into the coaching program for free. So I wanted to end with like investing mistakes. So this is something that I want you to look out for as you get into investing. Number 1, not understanding what you're investing in. I already talked about that. Number 2, leading with emotion instead of leading with logic. Okay, don't fall in love with a company. I know you might buy a company and you see it go up like 50% or 10% or 20%. And you think like, okay, I'm gonna become rich off of this one company. No, don't fall in love. Lead with emotion. I mean, don't lead with emotion. Lead with logic. Lead with the research.
Numbers.
Yeah, lead with the research. Don't lead with emotion. Okay, number 3, having no patience. Understand that it takes time. Don't start investing today and then look at it tomorrow like, oh man, I ain't making no money, or oh man, I lost money. Nah, this is a long-term game. Number 4, trying to time the market. So a lot of people been asking me in my comments on TikTok, Instagram, yo, when you think the market's gonna crash? When you think the market's gonna crash? I don't care. I'm not trying to time the market. Time in the market is the most important. And I'm about to show you why in a little bit. 5, failing to diversify your investments or portfolio. This is the most important rule of investing. You have to diversify. You have to, especially long term, you have to diversify. The great thing about investing in something like VOO, there's 500 companies. If 1 or 2 of the companies go out of business, first off, it wouldn't even make it that far because the S&P 500 gets rid of companies as soon as they have 2 years of bad earnings. They get rid of the company and they replace it with a better one. So that should never happen. But even if 2 companies went out of business in that, you got 400 companies that's going to bring up the brink of that. So you don't have to worry about a market ever crashing. You don't have to worry about all that. When a market crash, invest more so that you buy more shares. When a market crash, prices go down. That means things are on discount. That means you can buy more because things are on sale. Buy more so when the market goes back up, like it did in 2020, the market crashed like 30%, y'all. And then it came back up and we ended up over 17%, 20%. That's why they say the rich get richer, because as soon as that happened, the rich had cash on the side, they put more money in, and then when it went back up, they tripled their money, doubled their money. So don't be scared when the market goes down. Get excited. I get excited. I love when the market goes down. That means I'm getting stuff on discount. So here's how to avoid the mistakes. We do everything that I just said today. Create a game plan, understand your goals, what you want to accomplish, how much you need to retire on, why are you even investing? Are you investing to build wealth? Are you investing to leave to your kids, or are you investing to build your own retirement? Okay. And number 2, automate your plan. Again, we have to take the emotion out and just automate it. Put money to the side into this account each and every month. Put as much as possible as we can. And then we can check it 1 or 2 times a year just to check it, just to make sure everything is working, just to make sure the money is actually invested. Okay. So here, real quick, the difference between buying individual stocks versus buying ETFs. Buying individual stocks is a little more risky. It's for more experienced investors. You can end up not being diversified by falling in love with a certain sector, and it requires daily research, like a lot of research. Buying ETFs is less risky. It's a simple long-term strategy for all investors, no matter what age, no matter how much experience, none of that. And it's diversified and it's very passive. That's why I like it. So back to what the experts say, and back to your question. I believe that was Derek about how do you find fund managers and how do you find good ones and all that good stuff. So like I said, this is what the experts say. Don't try and time the market or sell stocks short term. If you missed out on the 10 best days, this goes to time in the market. If you missed out on the 10 best days between 1980 and 2010, your average return would have dropped to 5.7 from 8.2%. The longer you stay invested, the greater the chance you will capture the market's uptrend. The market always goes up. Since it was created, the market is always going up. Even when it's going down, the market's always going up. You will greatly improve your chances of posting gains over a 20-year period if you buy the bulk of your stocks when they are selling cheaply. So basically, when there's a recession, when everybody is scared, people are selling everything in the market, you want to go into the market. That's when things are cheap. And winning strategies include dollar cost averaging, which is what I teach. Put $100, $200, $300, $400, $500 away every month. That's going to allow you to buy more shares when they are cheap and fewer when they are pricey. Investors who deploy their cash at end of the world scenarios also tend to do well. So meaning when you invest during a time like the crisis, and when you put more money into the market, when everybody else is scared, you tend to do well. That's from, I believe his name is Dave or Barry Siegel from the Wharton School of Finance. Here's the reality. Here's the reality. So remember about fund managers and people picking your stuff for you. So in two, not one, in two 30-year studies, the S&P 500, something like VOO, outperformed 97% and 94% respectfully out of those two studies of managers. So in addition, only about 12% of the top 100 fund managers repeat their performance in the following year. So even though they have a good year the first year, it's only 12% repeat the next year. Therefore, it's not possible to consistently pick next year's hot mutual fund manager. All right, this is from the experts. From Warren Buffett himself, most investors, both institutional and individual, will find that the best way to own stocks is through an index fund or ETF that charges minimal fees. Those following this path are sure to beat the net results after fees and expenses delivered by the great majority of fund managers or investment professionals. This is from a book called A Random Walk on Wall Street. The dude said, after all, a random walk in market terms suggests that a blindfolded monkey will have as much luck selecting a portfolio as a professional. Nobody can tell what the market is going to do. I don't care how many times they tell you this. I don't care how much proof they show you. Nobody really knows. Like a blindfolded monkey will have as much luck at selecting a portfolio as a pro. So investing long-term, investing in the S&P 500, don't get caught up in the trends. Don't get caught up in, the fund manager or the best pro out here. Just get caught up in dollar cost averaging and investing monthly. All right. So that's pretty much it. The only thing I wanted to show y'all was the investment calculator. The investment calculator that I use, this is from Dave Ramsey's website. If you type in investment calculator or Dave Ramsey investment calculator, this is what's going to pop up. This is going to help you determine how much you should be investing, how much you should put into your investment account depending on your age. Okay. So you can go to this calculator right here. It's very simple. It asks you 5 questions. Put in your age, whatever it may be. You're 30. Put 30, put in the age that you plan on retiring. So if you plan on retiring at 65, okay? You have nothing saved. Let's say you have nothing saved. Let's say you choose to do $100 per month. And let's say you put in the VOO, which did 14.97%, but let's just be safe and say 12%, okay? If you did that for 35 years, you have $643. But wait, there's something called compound interest, where those 2 little years matter. So if we wait a couple more years, that's an extra $200,000. $100,000 a year. All right. You know what I missed that I didn't tell y'all about? The rule of 72, man. How did I forget to tell y'all about that? All right. So you go through there, you go through here and you play with this. You put in your numbers. You want to see how you would end up or what the numbers would look like. If you just added another $100 to that, 1.6 million. Find a way to add 300. 2.4 million. Find a way to add 4. 3.2 million. Find a way to put 5. 4 million. All right. This type of stuff gets me excited. Like I love doing the numbers. I love looking at the numbers. I love, putting different scenarios. I love putting in like, what if I had 10,000, right? And I contributed $100 per month. What would it look like? 1.6 million. What if I didn't add anything? What it would look like? 829,000. Wow. So if I just saved $10,000, put it in the VOO, and then wait till retirement, boom, I have $800,000. I could have $800,000. Like this, I just go around and I play with this. This is the type of stuff that will open your mindset. That will open your mind up and have you just come up with different scenarios. Like, how can I get there faster? What do I need to do to retire by 50? So 20 years. How much do I need to invest? All right, this is the type of stuff I do all day. I just play with it. I just play with it. Like how much, like what do I need to do? Okay. So that's it for the class. It went over a little bit. It's been an hour and like 15 minutes.
I'm
Just a
sorry,
little
what was the
bit.
rule of 72?
Say that again.
What was the rule of 72?
I'm about to go to it right now. That's why I just put up the slide.
Hold on. I have a question.
Yep.
Hey, this is Jamila.
What's up, Jamila? How you doing?
I'm
Oh,
good.
Jamila.
So based on your example, if I put 10,000 in like the VOO or S&P 500 account and never invest another dollar in the account and just let compound interest work.
Interest. That's the word.
In let's say 30 years, I could have the $800,000. Is that what you were saying?
Let's go back. Let's go back. Let's play the game. Let's play the game. So if you invest into a Roth IRA, you can't take it out until 59 and a half or 60.
Okay, put the age at 33.
The age at 33.
Yeah.
Earn 12%. Hey, that's 251,000.
Off of $10,000, that's not bad.
Okay. 18.
All right, yeah. Let's look at.
God.
This is why you got. This is why you got to. This is why you got to start investing ASAP.
Yes, sir.
Right.
Let's go. Yeah.
All right.
Just Google Dave Ramsey investment calculator.
Yep, that's it. But look, if you
Okay.
add, so what was it? 251,000, and if you find a way to add 300, all right.
Yeah.
Boom, there go your million almost.
Wow. Okay. Thank you.
Yeah, it's possible. We just gotta spend our minds. We can do it. So let's talk
And
about.
I can set up an account for my daughter.
Yes, you can absolutely. You can set up a custodial account. You will be the owner until she turns 18. So your job from now until she turns 18 is to teach her about all this stuff, so that when she gets in control of it, she can just keep it going.
But she won't be able to take anything out at 18, like if I wanted to do it for college.
Oh yeah, so let me take y'all to that.
She said
Roth IRA. All rules. So as far as I know, okay, You can take out money from a Roth IRA for higher education expenses. You can take $10,000 out to buy your first home, all tax free. It's actually called qualified distributions. My bad. I put withdrawals. So qualified distributions. Yeah, used to buy, build, or rebuild your first home, a $10,000 maximum. You can also take it out for school. Where is that at?
There it is, education.
So you won't.
Qualified
So
educational
non-qualified
expenses.
distributions are withdrawals that don't meet you'll pay taxes at your ordinary income rate. All right, so this one will be taxed. So higher education will be taxed. I'm sorry.
Okay.
But it'll only be taxed at your tax rate, and not the additional 10% penalty won't happen. So usually when you take it out early, you get 10% plus your tax rate.
Okay.
But yeah, let's go to the rule of 72. This would be something cool. So y'all can take this from the class and be like, yo, Coach Vince taught me this, and you can go to any room and you'll be the smartest person in the room. So the rule of 72 just tells you how many years it's gonna take for your money to double. It's gonna tell you how many years it's gonna take for your money to double. The equation is you take 72, divide by your interest rate, and that equals the number of years it takes for your money to double. So let's do the bank example. The bank averages 0.05%. That's the interest rate. 72 divided by 0.05 is 1,440 years. So if you put $1 into the bank, you will not be alive to see it turn to 2. Goodness gracious.
Wow. Wow.
Now, if you invest into something that's earning a 10% interest rate, okay, 72 divided by 10 is 7.2 years. So it's going to take 7 years for $1 to turn to 2. Now let me show y'all. Oh, I got rid of Morningstar. I was gonna take forever to come up. All right, let's see. I love doing this stuff. If y'all can't tell, I love this. I could do this all day.
Can I ask a question while you're pulling that up?
Yeah.
Okay, this is Francis. Say, for example, with you knowing so much now, but when you initially start, if there was one thing that you can think of, a mistake or something you would know not to do, what would you tell your younger self not to do now that you've been doing it for so long?
What I would tell myself not to do?
Yeah, you see what I'm saying? Like, if you could turn back the hands of time, what's something you wouldn't do now, knowing now that you could have done then, but you didn't know it then?
Yeah, perfect example. So I went to college for free. For football, I was on a full ride scholarship, so everything was paid for. We used to get stipends every month. I used to get like $2,500, and I didn't really even need it because they paid for everything. And plus, I got FAFSA, financial aid. So I had a whole bunch of money, and I just blew it on girls and parties and all that type of stuff, and having a nice truck and all that. And yeah, I didn't invest none of it. So I actually put up a post on my Instagram like a few months ago, saying like, man, if I had knew what I knew now, I'll be very well off just investing all that money over those 4 years. Like, imagine $5,000 a year invested over those 4 years, how much I would have had right now in 10 years. Like, knowing what I know now, if I'd have put that in the VOO, I would have about way over like 50,000, way over 60 probably. What am I looking at? VOO. So yeah, that's what I would tell myself. Don't stop showing off. Like, why are you spending your money? Stop spending your money stupidly. You know what I mean? Invest this money. But they didn't teach me that in college, and I don't think they wanted me to know in college. So yeah, unfortunately, that's where a lot of people find themselves, and you know, you live and you learn. It is what it is. I learned from it. It won't happen no more. Believe that, and best believe, my kids gonna be very well set up. All right.
Also, is there a difference between like an RI? What is an IRA and a Roth IRA, or is it the same thing?
So an IRA is an individual retirement account. So you can have a traditional IRA. So a traditional a traditional IRA is just a traditional individual retirement account, and that's just pre-tax dollars. So money that you put in there is not taxed, and it's money that you can write off. If you have a Roth, the Roth is after tax dollars. So any money that you take out will not be taxed later on. I always say if you're like 50, 55 plus, just go ahead and get a traditional so that you can save money now versus later. If you're younger than that, if you're like 50 and younger or 45 and younger, get a Roth so that you can save money later. Because you 45, you still got 20 plus years to be invested. So you can save a lot over those 20 years. But I brought this back up just to show y'all the example from the rule of 72. So this is it's done about 15%. So if I pull up the calculator, because I'm not gonna try to do that in my head. Calculator. Do 72 divided by 15. Like every 5 years, my money's gonna double. Okay, so if I put 10,000 in the VOO, where we at with it? I put 10,000 in the VOO. This is a 10-year chart. So it would have almost doubled twice, which it almost did. So the numbers work in real life. Just to let y'all know, it almost doubled twice. So 10 turned to 20, 20 turned to 40, right?
Yeah.
So there we go. The numbers are real. So let me put the camera back on me. We are done.
This was the best $5 I've ever spent in my life.
Was it?
I agree.
Was it really?
I agree.
Yes.
Forget about that coffee bean at Starbucks.
Definitely worth
it. I appreciate y'all so much, for real.
Bro, it's
very
10
sharp, dude.
o'clock right now. What? I thought it was like
that means
like
9. Yeah, you made it real simple, man. You made it real simple, easy to understand.
Very,
very. That means so much to me. I don't even.
Very, very simple.
Wow.
So when's our class, Coach?
All right, let's see. I'm about to put all y'all into a like a name picker real quick.
Yo, let me get this.
Yeah.
That'd be dope. That'd be dope.
Yeah.
Man, good luck to everyone, bro. I'm trying to get this. I'm trying to win this.
No, aren't we all?
We're in the name picker. Let's go.
Exactly.
Here we go.
Let's go.
Hey, yo, good luck, y'all. Good luck.
Yes.
GG, GG's.
GG, what?
Good
Donna,
game,
Donna.
All right, let me try and do this as fast as I can, man. I appreciate y'all though, for real. That means a lot, what y'all just said. That was worth more than 5. I appreciate y'all.
Hey, Coach, also, how do I deal with this phone call? How do I schedule that? Because I need to get this this VOO thing.
Yeah. What are you on my TikTok or my Instagram?
I was on your TikTok.
If you go to TikTok, the link in the bio, You can schedule a free call. I believe it's the last button. When you go to the
Okay, cool. All right, I'll do that.
Yeah, schedule the best time for you, man. I can't wait.
Okay, cool.
Oh, I do have a question. So I do get dividends from my public stock.
Yeah, you get dividends.
Quarter. Yeah.
That's good. That means they paying you double. So it goes up in price and you getting dividends. What are you thinking about doing? Are you trying to get out of that? Like, or are you just
No, if it's growing, I want to keep it in there for it to grow. If it's not growing, then I want to take it and invest it somewhere else.
Got you. Makes sense.
I can work for them part
Let's add these names. Add these names. Here we go. Let me try to nest.
You might as well just get and give it to me because I know I got that.
What, man? Stop playing, bro. What?
Oh, I don't think so.
Let me get these names right. I'm excited. Let's get it. Here we go. We got Donna.
Yes.
Hey, Donna.
Yes.
We got Krista.
Yeah.
Garrick.
Yep.
Jamila in the house.
Yo.
Dana.
Yes.
Keisha. Ingris.
Here.
Daisy. Who I'm missing?
Patricia.
You're missing the most important. Quasi.
Mauricia.
You put mine in?
Marley.
You put Ari in?
Audra.
Hold on. We got
Ari.
Marley.
Yes, sir.
Joel. We got Keisha.
Yes.
Well, Lisa, Marisha.
You put mine in there?
Jessica, JD, Ia.
Donna.
Who else? Megan.
Don't forget Bree.
Did you say me?
Bree.
Sierra.
Sheena.
Put Marley in there 2
Dana's
times.
here.
Don't forget Tanya.
Tanya.
Don't forget Audra.
We got Ari.
Don't forget Ron.
Ari, yes, sir.
We
Ari.
got Sarah. We got Ron.
You got Quasi like 3 times in there.
Andrea. Caitlin.
Patricia.
Trisha.
Sean.
Who's that?
Sean.
Sarah. You said Owen?
Sean.
Sean. What's up,
Sean.
Sean?
Yeah, what's up, man?
What's up, dog?
All right.
I think that's everybody. Sarah,
I'm in. Did you say Francis? Sarah, I think I'm in here twice.
I didn't hear my name.
Sheena.
Sheena?
Sheena.
Oh,
Yo,
yeah,
Coach
I got
Vince.
Sheena. I got Sheena.
Coach Vince.
You have Audra?
Ayo, Vince.
Wait, who is? Okay, we got
Scenario is the same as Audra.
Saneri. Is Saneri in here?
Yeah, that's the same as Audra. You could put Scenario, it doesn't matter.
Okay.
Who is me?
Yo, Vince.
Oh, we got Brandy. I can't forget about you, Brandy. I got you.
What up?
Got you. All right, I think we got everybody. Let me go through it.
Yo, Vince.
Let me go through it. Let me say everybody's name. Make sure I got everybody, okay?
Okay.
If you don't hear your name, let me know. After I get done. So we got Donna, Krista, Garrick, Jamila, Latasha, Dana, Keisha, Ingris, Daisy, Marley, Joelle, Keisha, Quezi, Lisa, Marisha, Jessica, Dayden, Gia, Megan, Bree, Sheena, Tanya, Ari, Sierra, Ron, Andrea, Caitlin, Patricia, Sarah, Sean, Francis, Sanair, Brandy, and that's all I got. Who am I missing? Nobody.
Yo, Vince.
That
Yo,
boy
Vince.
good. Hey, what's up?
Hey, if I guess who wins, is it like a second place winner or what? What if I guess who wins? What if I guess who wins?
We about to see who win this thing. All right, you gonna listen. If you don't win, you're gonna have an opportunity to get in. I'm gonna tell you how, okay?
All right, I'm gonna guess that
right.
Dana. I'm gonna guess that Dana wins.
So
I got you, Dana.
You mean Donna? No.
Donna,
You
yeah,
mean
Donna. I
Donna.
just read the first name.
No.
So this is what I'm gonna do. I'm gonna share my screen so y'all don't think I'm scamming y'all. Here we go. I'm gonna share my screen so that y'all can see it. All right, can y'all see it?
Yeah.
All right, we got every name in here. All I gotta do is hit submit, and then
The name on the top of the list is the winner.
hold on. Let me record this.
Let's go.
Let me record this. Here we go.
Let's do it.
All right, here we go. 3.
Bring it on.
3, 2, 1. Let's see who wins. There you go.
Yes, sir. Yes, sir. Yes, sir.
Donna.
The winner is.
Oh man. Oh wait. Yo, this wheel is messed up, man.
Yeah.
Yeah, it's going so glitchy.
Here, Sinead.
Oh.
No.
Yo, hold up. Stop playing. Stop playing.
Nah, you about to have to spin again, man.
Stop playing. Oh man, that's some bull.
Donna. Keep on going. You almost there.
Hey,
Sheena, congrats.
Yes.
There you go.
Thank you.
Let's go, Sheena.
Congratulations.
Congratulations.
All right. Let me make sure I got your email so that I can send that to you. All right. Let me find Sheena here. Yep, I got your email. Is this your correct email? Do you mind me saying it?
You can say it.
I don't even know. So
It's Mondesire. Yeah.
mondesiresheena@gmail.com. All right.
Yes.
I got you. So I will be sending you free access to my coaching program. You already know what's in it. You get my entire financial library, financial training camp, financial defense, financial offense. You get access to me, to my Telegram. We can talk daily. If you got any questions, you need help, you got that. You got you get to see my stock portfolio, anything that I buy, anything that I sell. Mind you, I'm an aggressive investor, so I may have some things that's different than you're used to, but I'm trying to get back to myself.
Yo, so that program's $1,000 a year.
It's $1,000 a year, but check this out.
1v1.
Check this out. All right. Tonight, okay, I'm letting people enroll $10 per month. So if you want to join,
yes,
it's $10 per month. Okay, we'll be able to do this weekly. We'll be able to hop on calls like this weekly. All right.
Okay.
I'm gonna put I'm gonna have to go to.
You can put me on right now.
I'm gonna put the link in the thing. If you want to join, it's only $10. Okay, $10 a month. It's originally $100, but I just want to help. I really just want to help. So if you join and be a part of this, hold on, I'm trying to get this doggone link.
You gonna put it in the chat?
Copy. Join. Remember, my goal is to help you make smarter financial decisions, build 5-figure savings, and invest to build wealth. I don't want to charge you an arm and a leg. I want to help you make an arm and a leg. So by joining my program, hopefully you will make more than $10 per month. That's the goal. It will be worth way more than $10 per month. That's the goal.
That's $5. This $5 was hella worth it.
Yeah.
Right? So let me get back. I don't know why I'm having trouble getting back to the Zoom. All right. I might have put it in the chat. Here we go.
In the chat.
Somebody got a joke. Somebody said, bro, did someone ever tell you you sound and look like 50 Cent? I get that.
Oh, yes.
I get that all the time. I get that all the time. All right, so I just put the link in the chat. All right, if you want to join, you can go ahead and join. It's $10 per month, and you get a 7-day free trial. So if you don't like me for 7 days, you can get up out of there. All right, boom.
Action.
This is for y'all, man. This is for y'all. This is like the founders. This is like the founders. So y'all are the first people that's gonna be in there, and this is the group that I want to be with. Y'all are all amazing. I appreciate y'all so much. So I'm basically giving away my program. I thank y'all for the support, for real. Y'all are
Question.
We appreciate you.
Yeah, suggestion with this. With this.
Have a little tablet full.
Thanks a lot, man.
You have a little note.
Y'all just don't know.
Coach Vince, the GOAT, man.
I'm happy to help.
Coach
All right, good
Vince
night,
is the
man.
GOAT.
We appreciate it.
Yeah, no doubt. So I'm about to hop off. Did everybody get the link?
No, I didn't get the link.
Yeah, I got
It's
it.
in the chat.
I don't know where the chat is.
I'm signing in right now.
Oh,
as we
you
speak.
gotta
Oh, I
click
see the
on
chat.
the little
Push
chat.
on more.
I got it. Thank you.
Will you be sending a recording of this?
I'm gonna wait.
Oh yeah.
15 minutes.
Will you be
Yeah,
sending for
I'm about to end the recording right now.
Yo, I need. Yeah, how, you can like DM me that. How are you gonna send the recording?
Hello?
Yeah, how are you gonna send it?
Yeah, what Aries?
I'm gonna send it to your email.
Okay.
Oh, okay.
I bet.